We're off to the races. All right. Got to grab our disclosure. So, good morning, everyone. I am Timothy Yee with Green Retirement. I am a registered principal offering securities and advisory services through Independent Financial Group, LLC, IFG, a registered broker dealer and investment advisor, member FINRA, SIPC. Green Retirement, Independent Financial Group, and Sensiba are unaffiliated entities. We won't be talking about investments today, but past performance is no guarantee of future results. Phew, we got that out of our systems. Well, folks, as we welcome Renee in, and Renee's up in Oregon, I just wanted to, before we dive in and introduce Tami, I wanted to get a quick sense from everyone. And let me make sure. Oh, there's Renee, there's Betty coming in. I want to get just a quick sense, folks, as to what you want us to focus in on. Tami has 27 years in tax. She loves tax. We can agree on that. We will certainly be talking about individual tax issues, but we're also going to, if there's interest, I'm going to ask Tami just to choose the one or two things that a nonprofit should do, or the one or two things that a business should do. And again, Sensibo works with businesses and nonprofits all the way up to seriously large. And I respect that I'm just little old me here at Green Retirement. So, we're going to try to tailor the advice, but this will be very much open discussion. But is the preference on the individual side, I would assume? And please unmute yourself, shout it out, write it in the chat. Rose will keep an eye on things. Okay, Natasha says yes to the individual side. Thank you for that. And I know some of my nonprofits and businesses, of course, have their own accountants, but I just want to make sure I'm really dialing this in and not going down a rabbit hole one way or the other. John is on the individual side. Okay, Renee says individual. Excellent. Rose wants individual and business. Good. All right. Let me keep an eye there, see if we have any of our. Okay. All right. Well, it's looking, Tami, like the definitely okay. Individual and family office from Nick. That's old hat for Tami. So, thank God we got that covered too.
Okay.
All right. Good. Let me just get Brian in. And sorry, it's a little chaotic. I just really want to make sure we provide the right value because what I vaguely remember of tax is that it's quite complicated. There are many different rabbit holes you can go down, and all right, let's see. Is Brian in? Brian's in. Excellent. Good morning, Brian. Just a quick question that we're throwing out is, do you want the focus on individual, on nonprofit, or business tax? Feel free to drop your thought into the chat box. We're seeing a predominance on the individual side, and Rose wanting a couple of thoughts for small businesses, and one person asking about family offices. So okay, Sanjeev individual. Excellent. Thank you, Sanjeev. Appreciate that. All right. Well, against that background, it is my pleasure to welcome Tami Arnold. Tami, thank you so much for being here. 27 years in tax, a bulldog out of Fresno. I think that was Jerry's group, wasn't it? Jerry was
I
the
think
coach of the
so.
best. Jerry Tarkanian. Yeah.
Exactly.
Yeah. Yeah. Good old Jerry. Well, one of my clients did ask that I give a little bit of an overview before we dive into the tax. And, I'm happy to do that, folks. As I look at the Dow Jones, and yeah, we've had a couple of trips over the last 2 days, but in general, we're looking at a Dow that's up over 17% from January 1st. Certainly, that is a commendable return. But as you know, at Green Retirement and our focus on social justice, I do not equate stock market return to people's individual economic situation and say, wow, we're all doing great. And also, just because the market is up 17% doesn't mean your 401k is up 17%. If you had invested in a money market or bonds, you would have different returns. Or if you had gone with some of our more hyper aggressive investments like biotech, you might have seen different returns there. But I'm always happy to chat with you folks one on one. I will include, as Tami is giving her remarks, I will include my calendar link. Right now, I'm scheduling for January. So when you click on the calendar link and see a lot of blacked out dates. The HIP models, well, thankfully we do have the HIP person on the phone and he can definitely talk to that. Paul, if you want to grab your latest returns and be ready to speak on that point. Um, anyway, yeah, overall, the other question that I got is what kind of administration is best for the stock market? Is it a Republican administration or a Democratic? Actually, the study from American Fund shows that it really doesn't matter. Once you get through the first initial months, first, when the election is being decided, which it has, and then the first few months of the presidency, pretty much the market has a good sense as to how a person is going to perform, and the markets tend to perform equally well under either. And that's looking back to 1910. So it's a fairly long stretch of time that they ran the history. Anywho, I think those were the main things there. Paul, if you would be so kind as to speak on the HIP portfolios. Um, for those of you who don't know Paul Herman, Paul has 5 models available in the 401k plan, and some of our plans use them. They range from 100% stock down to a 20% stock and bond um, allocation. And Paul, maybe you could speak to the socially responsible fossil fuel free side of it as well.
Yeah, thank you, Timothy. Thank you, Rose. Appreciate it. I am Paul Herman from HIP Investor. Nick Gower on the line is from HIP Investor as well. So inside 401ks, several of which we co-deliver with Timothy and Rose at Green Retirement. There are 5 target risk, we call them target risk portfolios. So you may have heard of target date portfolios where you pick a retirement date, and target risk. So the target risk means 100% equity, that's the most aggressive. It's all equity funds, domestic equity, international equity, but also things like natural resources. And the natural resources are not oil. The natural resources is water and clean water solutions. There's also companies that are making heat pumps like Trane and Carrier. And so these companies are inside funds and the funds are inside the portfolio. Then if you have an 80% or 60% portfolio, and the assets that in a 401k typically are longer term, so they tend to be at more aggressive at 100% or 80% equities. Those the lesser conservative ones are funds that are paying 3, 4, 5% yield. So they're invested in U.S. Treasuries, they're invested in local social bonds across the country. There's a firm called Community Capital Management. And so from the social impact and the environmental impact point of view, we only invest in funds that avoid coal, oil, and gas producers. And we tend to invest in funds that have more efficient greenhouse gas emissions per dollar of revenue. And so that means relative to an index, like a Vanguard index or other index, you have more environmental efficiency and similar or close financial return. So the returns vary by how aggressive or how conservative you are, but they're generally in line with index solutions. Sometimes they run a little bit more, sometimes they run a little bit less. So you can get similar financial performance on average over time with better environmental outcomes, social outcomes, trust outcomes. So those are called the HIP Investor fossil-free portfolios, which are diversified. So feel free to add those to your 401k.
Thank you, Paul. I appreciate that very much. All righty, Tami. It's time for the tough questions. I hope you're ready. Okay. And folks, I have a few questions that I have already gotten emailed in, and we're going to put you on the hot seat. But again, with 27 years of experience, what is the one thing you want the individuals on this call to do before year end from a tax point of view? If you could just say one thing and we're ending the call, what would it be?
I would say to seek professional advice. I think our tax situations change from year to year, and I can give you tax strategies out there, but really is having an understanding of where you're at currently in your tax situation and where you want to go. And I think a lot of that, once you have that information, it's sitting down with a professional and getting professional advice. And that's not only from a tax standpoint, but it really is from either a legal standpoint, an investment standpoint that you really need to look at. It's a gathering of your full portfolio of who you are, both tax, financial, and legal. And to make sure that your taxes, your situation, that you're actively participating in it and planning for it. And then from there, once you know where you're at, you know where you want to go, and you're seeking that professional advice, you can do those tax strategies that are best for you in getting to that goal, ultimate goal. And so whether that's harvesting losses that you talk about in investments, taking loss investments and offsetting it against potential gains that you have in a year, deferring compensation, whether that's a retirement plan, utilizing tax deductions such as charitable donations, business purchases throughout the year, having the proper withholding or estimated tax payments, optimizing benefits that you might have, whether again, retirement benefits, health insurance benefits, flexible spending, and then just kind of developing also too in your plan goal, what future goals you want for future investments and planning, such as gifting that you might want to do throughout the year, whether that's in a 529, plan for education, reviewing your existing plans that you might have in place, looking at wills, trust, beneficiaries that you have. All of that comes into play, but I think the first thing is knowing where you're at, knowing where you want to go, and then sitting down and seeking that professional advice.
Well, then to that end, for somebody who's, and I think back to me when I started in the industry, I didn't have two dimes to rub together. I'm sure my taxes were quite basic, but one thing that I always did at year end was the frantic dash to the charity shops, trying to clear out, you name it, I got rid of it. And while my wife was in the Philippines, I got rid of a bunch more stuff because she wasn't around. Is that even a thing anymore, to donate anything and everything from books to clothes to the odd utilities? And then Paul's popped in a few questions, which we'll jump into as well.
Okay. I always encourage charity. So in any type of form, whether you're going to get a tax benefit or not for it. I will say from a tax benefit side, it's a little bit less now that you would get a tax benefit. So there's two types of deductions on your return. One is called an itemized deduction, where you would take things such as mortgage interest, state, local taxes, charitable donations, points on your mortgage, medical expenses. Those you would consider to itemize, and those will come up to a certain dollar amount. And either you will take the itemized deductions, or the other side of it would be to take the standard deduction that's provided by the IRS. And that standard deduction for like a single individual is around 14,600. Married, finally joined, it's around 29,200. And for had a household is 21,900. So you would actually, your itemized deductions would have to exceed that dollar amount before you would even get any benefits from those itemized deductions. And unfortunately, charitable donations are included in there. So what I will say, the majority of people are now not itemizing, they're actually doing the standard deduction. So any charitable donations, you're not really getting a tax benefit from. But there's other ways around that. If you are an older individual, 70 and a half, and you want to donate, and maybe you have clients that are in that situation, or you're in that situation where you would like to donate, even though you might not get an itemized deduction for it, you may consider what's called a qualified charitable donation. What that is if you're over 70 and a half, you can donate directly from your IRA to the charitable organization. You want to make sure they're qualified, of course, and they have non-exempt status. That way you can satisfy things like RMD that might be coming up. Of course, that's not until the age of 73, but then we're talking about 70 and a half. But also, it also gives you more bang for your dollar, because you're donating directly to the organization from your IRA. You don't get the tax deduction but you are also not taxed on the amount that is coming out from your retirement. And so
Okay.
what happens is you're actually donating with almost pre-tax dollars. So I
Yeah.
want to think from there.
Righty. And yeah, given that we do have, from what I've seen of the attendees, I would say a younger audience, the qualified charitable donation, folks, I would say is something to bring up to parents.
Right. Mhm.
All right. Paul asked an interesting question about, and you had a slide on this, I remember. Uh, and I'm just, I'm going to flip up my favorite tax chart, and we might as well dive into Roth.
Mhm.
All righty, let's get that. So, a little bit of for those of you who haven't seen this from the New York Times, a comment that Warren Buffett made. Warren, as a billionaire, said that he actually paid lower taxes than his secretary. And that didn't make a lot of sense. Why would the billionaire pay less than the secretary? He was insistent. The New York Times did a little bit of a look-see, and sure enough, Warren was right. And hopefully everyone can see the chart. But the chart is showing back in 1950 what U.S. marginal tax rates were, federal, state, and local, the total of those. And for the people at the low end, let's say about maybe 16, 17% total federal, state, and local. Middle class, I'll say somewhere around maybe 20%. And over here on the far right in 1950, the top 400 wealthiest individuals and families were at, let's say 70%. Now, as we roll through time, you'll notice going to 1980, there we go. 1980, still pretty much the same kind of skew. Those on the lower end are at 20%, middle class, I'd say 30, and those at the top bracket, the top 400 wealthiest individuals and families, about 50% federal, state, and local tax. 1980, as you know, Ronald Reagan took office. Ronald had quite a few things to say, but one of his more famous quotes is government is the enemy of the people, and you need to cut taxes. That line has echoed through since 1980, and just speeding through to the end of the last tax revision. Warren Buffett was right. When you look at the last tax cut, the bottom earners, I'll say 26%. Middle class, somewhere around maybe 28. And the top 400 wealthiest individuals, 22%. So I think this makes the argument for, especially in the 401k side, putting your money in Roth. Of course, you seek the professional advice that Tami suggested. High income earners may still go pre-tax. But Tami, why don't you weigh in? Pre-tax, Roth, and to Paul's question, is this a great time to do IRA conversions to Roth, given that the administration, the new administration, which we saw earlier, they seem to suggest they want to lower taxes again. And of course, my question to you, Tami, is where are taxes going? Now, I'm 56, so I've got maybe 15 years till I start taking money out. So get your crystal ball out, Tami.
I'm not really good probably on expressing what will happen in the future. I do see that, of course, taxes will continue to increase, I think, over time. I mean, I think you're going to have an annual increase. I don't see really a shift to increase taxes on corporations or the high net worth individuals. And I think a lot of the tax codes that are going to be expiring fairly soon, which do benefit potentially maybe the high net worth individuals, such as your estate tax, or bonus depreciation for some corporations. I really think that those will be extended.
Okay.
Those are set to expire. A lot of what you're seeing too is that the tax rates that you have noted on there and that they are decreasing for the higher 400, higher higher net worth individuals is really having to do with the type of income that they're in. A lot of their income is in capital gains, which is normally taxed at a much better rate, a 15 or 20% tax rate.
Mm,
For also too, it does incorporate estate taxes for the higher net worth individuals, which is actually the exclusion amount is quite high. It's close to, I think, 14 million for individuals. So their tax, which normally it was down around 5 million. So we've seen a lot more individuals not having to pay the estate tax. So that would be, of course, your higher net worth individuals. And of course, the
okay.
corporate tax rate has gone down too. So that
Right.
has benefited a lot of the potentially higher net worth individuals. As far as the Roth IRA conversion, for individuals that are, you know, maybe starting out in retirement, or even in the midst of, having still another, say, 15 or so years, that is definitely an item to look at. And the reason why is because with your traditional IRA, you do get the deduction up front. And understand, just throwing this out there, with a traditional IRA and a Roth IRA, you do have, of course, limitations on how much you can put in based upon income. So you got to keep that in mind. But with your traditional IRA, you're going to potentially get a tax deduction for it. When you go to retire, you are required to take distributions out of it. You do get a benefit if you do have what they consider basis, meaning you didn't get a tax deduction for it. You can take some of that out up front so you don't get taxed on it. But mostly it's going to be taxed to you, the earnings and what you put in, because you probably got a tax deduction for it. With a Roth IRA, it is growing tax-free for you. So you don't, again, similar to a traditional IRA, kind of growing tax-free until you actually take it. For a Roth IRA, you don't actually have to take minimum required distributions from that. So that is a benefit. You can continue to let that grow and potentially pass out into your state to beneficiaries. And it grows, and it also is tax-free for you when you take it out. So there's some benefits to kind of looking at the conversion. Be very careful though, with the conversion, you're going to be recognizing taxable income.
Yeah.
So you do want to make sure that when you're doing that, you're aware of your effective tax rate when you hit that next tax rate, because of course we have a gradual tax rate here in the United States. So, you want to make sure you're not pushing yourself into a higher tax rate by taking that Roth. You may want to take
Yeah.
it over a period of time as you're making that conversion over.
Well, I still do feel that tax rates, Tammy, I know you said they'll steadily increase. Again, just my personal view is we're going to have to raise taxes or cut services, and who wants to do that?
Yeah, exactly.
Turning to the question of tax strategies, and also, Renee, I saw your question on professional advice. So let me state that one, and then the tax strategies question. So, seeking professional advice, Renee was saying sometimes it's not the person who creates a return. My experience with the CPA world, though, is that you get very good advice. Again, using you as an example, 27 years, you've been there, done it, got the T-shirt. So yes, you may not personally type up the return. You may have an assistant who does that, but I would assume as a CPA, you would weigh in on the person's tax situation.
Oh, definitely, yeah. And two, again, just to emphasize, I'm only one cog in the wheel. I'm a tax cog. I really think that you have to take in consideration. I may advise you to, like we talked about, harvest your losses in your investment. That may
Mhm.
not fit into the long-term strategy you have with your investment broker. So I have to take in consideration that my advice is only one part of the advice. You really need to take the advice of legal, you need to take advice of investment, you need to take the advice of your retirement person too. It's all part of a group or team. That's really what you want to try to have behind you.
Okay. And Renee, please do follow up in the chat if we didn't hit it specifically.
Yeah.
Paul is also asking on tax strategies, and I think Rose is going to follow in. Paul wanted to talk, or have you talk about electric vehicles, strategies related to that. I don't think a 1031 exchange necessarily, well, it could be a a tax saving strategy, but
Yeah.
Rose, did you want to add into the tax strategy question? So we've got EVs, 1031s, and Rose, what did you want to pipe in on?
Oh, thank you. Thank you, Tammy. You mentioned tax harvesting, and I think it might be good to just talk a little bit more about that, because some of our participants might not be as fully aware of the benefits of tax harvesting. And also, if you can like give, are there like exact amounts in terms of losses that you can offset in a given year, and is it available for you in succeeding years?
Okay, those are great questions, Rose. With regards to what I was talking about tax harvesting, so for individuals that have, and this is not your 401k, but this would actually be your personal investment accounts. You want to look at your portfolio as a whole, and if you have uh, potentially maybe substantial gains, but you might have some lost stock that are there. You may want to consider selling those stocks that are at a loss so that you can offset it against the gain. And what you can do is you can actually take losses up to $3,000. So you could actually wipe out all of your capital gain and also take another $3,000, which could be offset against your other income that is on your tax return. Now, some people will say, well, what if I have more than $3,000 worth of losses, which we hope you're not in that situation. But nonetheless, I've sold stock, I have a huge loss. Say I have about $10,000 worth of a huge loss. You can take 3,000 of it. And the thing is, you don't lose on that 7,000 that you weren't able to take. You can actually carry that forward and you can offset it against future gains that are coming through. So just to kind of keep you, let you know about that. It's not something that you actually lose. I hope I answered your question.
Can you clarify, so you can offset the $3,000 off of
Correct.
your regular income? I thought it's just your investment gains that you can offset it with.
So what you would first do is you would offset any losses that you had against your gains. And then what is left over, if that amount is, as we mentioned in my scenario, if that amount is 7,000, say that you have, or 10,000 in losses, you could take 3 against your, say, your W-2 income or your interest income. You can take 3,000 against that, and then that 7,000 carries forward. Now, the following year, if you have no gains or losses, you can take again another 3,000 of that, and then that will carry forward another 4 into the future. So that's how that works.
Well, that's good to know, actually.
Yeah.
Rose's follow-up question or earlier question was on where might the Roth 401k be appropriate? My thinking typically is it's with younger employees who are already getting a tax refund. Going pre-tax would just give them a bigger refund. Somebody who's older, a higher income earner, getting close to retirement, say within 10 years, may not benefit as much from the Roth option. What do you think, Tami?
I definitely agree with you, because you do have a vested period of about, I think, 5 years on a Roth, which means that you kind of have to keep the money in the account. You can't really take any distributions from it. So I definitely would agree with you. I think you want to look at this probably earlier on, for your early retirement, people that are looking at retirement or put into a retirement account.
One question that I frequently get is on W-4s and 1099s. We'll start with the W-4. Again, by year end, or certainly before first paycheck in January. How frequently should people be reviewing W-4s, Tami? Again, and what is a W-4 in case somebody says, "Why?"
Exactly. A W-4 is informing your employer on what you want as far as federal or state withholding. You would indicate on there if you want the maximum withholding, you can claim single and zero. And you can claim single zero even if you're married. That's just to get the maximum withholding from your W-2, and you can actually add on there if you want additional withholding, taken from your paycheck. So that being said, I think you really should look at this on an annual basis. You know, life happens. And so are you going to be that person that's going to be life and happens to you, or life happens with you? And it's the idea of being actively participating. Now, again, this is a very easy exercise. Has your life changed in the last year? If it has, then you probably want to make some changes to that W-4. If it hasn't, it's probably is just fine as it is. But I think it is something to, you know, we normally do physical, you know, we go to the doctor, we do those annual checkups. I think you need to do an annual checkup when it comes to your finances, your tax, and legal issues going on in your life, making sure, you know, wills are updated, if, you know, and all of that. And it's a good time to kind of do that probably when you're getting your tax return ready. I know all of us dread doing the tax return for our personal lives. And so it's a good time at that time, since we're thinking about it, to kind of evaluate all of those areas, you know, our finances, our taxes, our investments.
Okay. Could you speak a little bit on electric vehicles and credits around that and solar panels? Basically, given that, you know, green and green retirement is about sustainability and the people on the call are very sustainable focused.
Okay.
What are you seeing in that arena that can be beneficial as a tax strategy?
You know, we still have a lot of the energy efficient credits that are out there. We do not know how the current administration will be looking at that. That is a point of concern for us. But I think because of everything that's out there, there are still credits that are available. Usually it's 30% of the expenses that you incur with regards to solar that would be deductible for you. And as far as energy efficient vehicles, before it used to be just on new vehicles, and a lot of people think I got to buy a new, you know, energy efficient vehicle in order to get these credits that are allowed. I think at one point they were around 7,000 or so. I would need to probably follow back up on with you on that. But now they're actually credits that are available for a person that does that buys a used electrical vehicle. So you want to kind of keep that in mind. Like I said, the standard deduction for a lot of these is going to be about 30% of the cost. And it's usually on some of them, they are considered what is a refundable credit, and some that are not refundable. So you want to be careful about that. I think most of your energy efficient credits are going to be a refundable credit. And that's why when you negotiate with your solar people, they're saying, okay, well, do you want the tax credit or not? Because you'll be paying maybe part of that back to them.
So on a $30,000 system, 30% would be 9,000. Are you saying I would reduce my tax bill by $9,000?
It is a dollar for dollar deduction. So yes,
Okay.
it would be actually, it's not at your tax rate. It's a dollar for dollar deduction.
Okay, so there is a benefit to solar panels, electric vehicles.
Correct.
Okay.
And just to let you know, a lot of those are on the federal side. Most of your state side are not considered tax credits as much as a rebate. So just to let you know that.
Okay. Rose?
I just wanted to chime in that for electric vehicles, there are income limits, but right now purchasing a new EV could give you $7,500 outright discount on the car because they put it up front. And so you just have to be mindful that your income, or you know, I think it's the adjusted gross income, Tami, and maybe you can speak about the difference between AGI and your W-2 income, because the AGI is the one that I think the car companies and the government is going to look at when they give you the 7,500 tax credit. And it really is nice because it's at a point of purchase that it is applied. And so regardless of whether you finance it with a loan or pay outright in cash, you get the 7,500 benefit right away. Of course, we need to consider that a new administration is coming in next year, and those tax incentives for EVs might just disappear.
Yes.
Doesn't it have something to do with the weight of the car also, Tammy? Or Rose, were you the one who told me that it has to be,
Uh,
your car
as
can't be
far
too,
as
it
far
can't
as
be
I
a
know,
really, it can't be a Cybertruck or something. There's something to do with the weight of the car?
the weight of the car is for business purposes,
Correct.
and so if
Oh,
you, yeah, I'm sorry. Yeah,
it's okay.
No, you're correct on that. I think there are certain vehicles, that are allowed these credits. So the IRS website will give you kind of a listing of, vehicles. And normally your manufacturer, your person that's out there selling you the vehicle will know that. But yes, Rose, you're very correct. Yeah, on the weight side, it has to do with how much you're taking as far as depreciation on a vehicle. And whether that's subject to luxury type limitations.
Hmm, okay. Other tax strategies that you suggest, and then certainly I want to make sure we hit on Rose's one-liner tips for businesses and Nick's on family offices.
With regards to just, like I said, I think most of the tips with regards to, year-end planning would be, of course, knowing where you're at with your tax situation. So it really requires you to kind of be organized in that area,
Hmm.
making sure that you kind of know your effective tax rate, and gather your information, from a small business standpoint. There are a number of different items to kind of look at, both from a tax standpoint, but just from a business operational standpoint, making sure, of course, your accounting is up to date. You've reviewed your benefit packages with your clients. You reviewed your retirement plan. There's
Hmm.
just a lot to kind of go into year-end planning, but I think a lot of it up front, again, seeking this advice is not going to be valuable to you unless you're organized. And so I tell a
Mm.
lot of my clients, make sure that you get you're reconciling your books. You understand financially where you're at. And then you can make those decisions. We're working a lot with our clients right now just to make sure that their accounting is up so that then we can actually do the planning.
Um, Two from Natasha and FSAs, HSAs, medical expense deduction. And then her direct question for homeowners, anything we can do tax-wise with increasing insurance premiums? Ooh, that is a tough one. Yeah, we have seen that in Florida where they're pulling out altogether in insurance, homeowners insurance markets. There's not really a deduction for insurance, is there?
There is some mortgage insurance deductions, but
No,
they're
no,
very,
insurance
oh,
premiums, though.
oh,
Yeah, I don't.
no, as far as you're correct. As far as deducting insurance from premiums, unfortunately, no. Mortgage insurance, there
Yeah.
is, but it's very, very limited. At least what I've seen on my end. Unfortunately, with a home, the only thing you're really looking at is your property taxes, which again, on the federal side is limited to 10,000, and then your mortgage interest on a personal home.
Oh, so there. I'm going to make a. This is why I don't do tax. I remember half-baked ideas from 20 years ago, and then they come out of my mouth. But there was. Oh no, I think that was rental properties. Something about the fixing up you do. You can do a depreciation on a rental property.
You're very correct. Yes, on a
Okay.
rental
If.
property. What I would do, the only thing is on a personal, and this is kind of maybe an exception, but I would keep track on any major improvements you make to your home.
Hmm.
Normally when you go to sell your home, you do have an exclusion. So if you've lived 2 out of the last 5 years and you've owned 2 out of the last 5 years your home and you go to sell it, there is a $500,000 exclusion for married, filing joint individuals, 250. So, and that means that of the gain, which is the difference between your purchase price and your sales price, you can exclude that amount. What I have seen, a lot of
Oh.
people, the values of homes have gone up substantially. So what they bought it
Hmm.
for is a lot more, but then they put a lot of improvements into it. So I would say keep track of those improvements. You never know in the future when you go to sell it, you might be able or might need them to deduct some of the gain, that you're recognizing on your property that you're selling.
Almost like a stepped-up basis is what I'm hearing you say.
Almost,
Okay.
yes.
So back to Natasha's question on FSAs, HSAs, and how about if somebody has ridiculously high medical bills, which unfortunately in our healthcare system, that is an issue. What
Definitely.
can you say about FSAs, HSAs, and medical?
Well, I definitely, if you are not having a lot of medical issues, and this is maybe for some of our individuals that are starting out their life, or two people that have maintained their health throughout the years, you may want to look at it, maybe doing a high deductible plan. And by doing a high deductible health insurance plan, yes, you do have more coming maybe out of pocket. You're paying less per month, but it does allow you sometimes to link up to what's called an HSA, a health savings account. And what it allows you to do is to defer some of your income into your HSA, which is again, a tax deferred item on the federal side. For California, unfortunately, they don't apply. But nonetheless, you're putting money away. And what I've seen is a lot of individuals are using their health savings account to grow tax-free. And if you take that money out for medical issues, it's taken out tax deductible. So they use it as a supplemental to your retirement. So you're not having to take out of your retirement to cover medical. You're taking out of your HSA to cover medical, and that comes out tax exempt. So if it's paid for medical purposes. So it's a supplemental retirement, I look at it. For your FSAs, those are a little bit different. So your FSAs, you're putting money aside for medical that's occurring. The problem, let me back up. On HSAs, that money continues to grow. You don't have to pay it out by the end of the year. So I can maintain an HSA account with my employer. I have a high deductible. If I put in 8,000 and I don't use any of it, it rolls over and I continue and it continues to grow. It's my account. With an FSA, it's different. An FSA, you put money aside, you use that for medical, tax deferred again, but you have to utilize it by the end of the year. Otherwise, you lose it. So be very, very careful. Usually some people will use that as a supplement to a regular health insurance plan that they might have.
All righty. And Natasha, do pop into chat if you want to follow up on that. We have 15 minutes to go. Rose, what did you want to ask?
I do have a follow-up on the FSA. Isn't there a limit? Tami, you mentioned you can put $8,000.
That was the HSA.
Yeah, HSA rather. I'm sorry. So the HSA is the one that grows. And so is there a limit to how much you can put? And is there no income ceilings or limitations on those, like IRAs?
So yes, with regards to an FSA, and I'm going to kind of read off one of my charts here. There is a limit for 2024. It's 3,200. For 2025, that's going to be 3,300. It is tax deferred, so it does offer you, you can defer that money into that, and it lowers your AGI, your taxable income. With regards to a HSA, you could actually, as a single taxpayer, put in it would be 4,150 for 2024. For 2025, that's 4,300. That's for single taxpayer.
Sorry, that was the HSA or the FSA?
That's for the HSA, the health savings account.
Okay, so health savings account
4,150 for 2024. And 4,300 for 2025.
And then it was the FSA. The FSA was 3,000.
Correct. And then just want to jump back. That's for a single taxpayer. For a married filing joint taxpayer for a health savings account, you can actually put in more because you're putting in for your family. So it is 8,300 for 2024. And 8,550 for 2025. So go ahead. Yes.
Oh, and so just to clarify, since it's a tax deferred account, it lowers your tax base for federal, but I think you mentioned that it doesn't work for California state taxes. I'm
Yeah.
just thinking that for our participants, when we send the follow-up to this First Friday 401k, this is a tax strategy that they can still do, right? So they can still put aside before year end the limits that you mentioned, and then that would in effect lower their tax base.
Yes, they can do that. The only thing again with a health savings account, you do need to have a high deductible plan. If you don't have a high deductible plan, you cannot do an HSA. But you are correct. If you have a high deductible plan in place, you can set up an HSA and you can make those contributions before year end. And you don't have to worry about spending it by the end of the year because it will just roll over. FSA, totally different. You have to spend it by the end of the year. Otherwise you lose it. Good questions, though. Thank you.
12 minutes to go. Phase out limits. Every year I get a question about wanting to fund an IRA, and usually when people call me, they are already covered by a corporate or a nonprofit retirement plan. I know phase out limits get bumped up, and if you could explain phase out limits, the income limits, and why the government doesn't want us to save too much. I'm still scratching my head on that one.
I am too. I definitely am. So what I would like to do real quick is just share
Oh,
the
and Paul wants
retirement.
you to talk about alternative minimum tax, so slide that in there.
I'll try to slide that in real quick. I'm just going to show this slide that kind of shows, and please let me know if you don't see that. Is that coming up okay?
Okay, yeah, all right.
So these are the limits for your employer sponsor plan for 401k starting in 2025. I did give some numbers here for 2024, but mostly these are toward 2025 and what you can contribute to an employer sponsored plan. And of course, I say max them out because in some, if you can, if it doesn't create a financial push for you at home. What I would do too, and I always, especially for the younger individuals that are starting out their careers, I try to say max out as much as you can, because on a lot of these employer sponsored plans, a lot of them have matching, which is a good thing. Some do not, but some do. On your traditional IRAs, you will be able to, of course, put in $7,000. There is a catch-up option for those that are 50 and older. And then in 2025, for this age range of 60 to 63, you will be able to put in another 1,500 as your catch-up provision. Again, there are limits to how to, so Tim was very correct. If you're part of an employer sponsored plan, you will be limited on how much you can put into your IRA and potentially your Roth IRA. So you need to be there are limits with regards to that as far as your overall AGI.
So, and the phase out limits, I've always felt, Tami, particularly for traditional IRAs, for a single person, I think it's like 90-some thousand dollars. It's very challenging for somebody in California to even be thinking about an IRA, and 90,000 doesn't go far in California. And again, we have clients across the United States. That seems to be a constant theme.
Yeah, definitely. So yeah, you do need to be aware of it as much as allows. I always say, try to do the employer sponsored plan, I think, first before you do any other. I mean, you can make some contributions to your IRA possibly, but it's better to go with the employer sponsored plan. But I'm sorry, you had one other question about
alternative minimum tax. What is it? What are your thoughts on it?
The basics with regards to AMT. So when I prepare a return, I actually prepare 2 returns for my clients. One is a basic return that most of my clients see. The other one is a return that's at a flat rate at 28%. And also to a lot of the itemized deductions that you would be able to take on your regular return, you cannot take for AMT. So that's what I do when I prepare return. I prepare kind of a regular return, and in the background, there is an AMT tax return at a flat rate of 28%. All depending, normally my clients are not seeing that second return I do because their regular tax return tax is more than the alternative minimum tax. And so, but there are cases where the alternative minimum tax return is higher, and so they will end up paying the higher amount. And that's when we say you're subject to AMT, alternative minimum tax.
So this is for what kind of salary are we talking, income, adjusted gross income thingy are we talking about here?
You know,
What levels are we talking about? It's
you're
not,
gonna be looking at individuals. It's not so much levels of income. It's more of what you're taking as potentially deductions, itemized deductions. So where I see this hit people is if they have a lot of extreme itemized deductions that might cause it, or they have AMT differences, meaning maybe they get a K1 that shows, AMT differences for depreciation. I don't see it often, and there was a huge issue. There's an exclusion amount too on your AMT return. So I don't see a lot of clients hitting this unless they have a lot of either itemized deductions or they have income, like maybe a lot of capital gains income where that's at a much lower rate. And this is at a 20, your AMT is usually at a 28% flat rate.
I'm having flashbacks to college. It was not a good experience. I'm sorry.
AMT is never a good experience.
I'm trying. I'm really trying.
Yeah. I think if you will probably know if you're in that situation with your accountant, because you probably have hit it in prior years.
Okay.
But yeah, I wouldn't per se worry too much about it. There was a fix done a few years ago that allows, there's a large exemption amount. I want to say it's like 115,000 or so in taxable income. So there's a pretty large exemption amount. So I don't see a lot of people hitting it. The only time I see it is when they have weird itemized deductions, or if they have a lot of maybe capital gains.
Okay. As we head to the top of the hour, one thing I do want to point out, because I get this question every January through April, your 401k contributions, whether they are pre-tax, Roth, or both, those show up on your W-2. That document is issued by your company or your payroll company. You can look at box 12. You will see your 401k contributions listed there. There is no separate tax document needed. Every year I get a call saying, I need my 1099 for my 401k. Unless you took a distribution, most people are actually calling saying, hey, I contributed. What else do I need? It's your W-2, folks. Now, if you took money out of your 401k, yes, there's a 1099-R. But there is nothing else beyond the W-2 if all you did was contribute. Look at box 12. Phew, got that off my chest and I feel better. All right, folks, with the final 5 minutes, other questions, anything, everything. You've got 27 years of tax standing here. And don't look at me, I have zero.
I just wanted to mention on the family ops, because I know somebody had mentioned about that, and that is unique. You having a family business. We actually do have somebody that specializes in our firm on family operations. So if that individual would like to reach out, I can get them in contact just to talk if there's, issues or stuff that they have. Tom Crotty is the one that I work with when we have family businesses, because those are unique in their own way.
So family offices, we've got a specialist, and again, Sensiba is a B corporation. I know you don't like your crystal ball, Tami, but Natasha is asking, do you see with the new administration capital gains rates going down? I think they're already low.
Yeah, I do. Well, they definitely will. I do not see them going down, and I don't see them going away, because right now, capital gains rates, there's actually a 0% rate, 15 and 20. And I do not see that changing. for the future. I know that seems awkward, but yeah, I don't see it changing.
Okay. Other questions, folks? And of course, Rose, if you have anything that I've missed, because you're the brainy one here, you think ahead. Anything else, folks? We talked on FSAs, we hit HSAs, capital gains. Anything else, folks?
The only thing that I also wanted just to mention, I know that somebody had mentioned about a 1031 exchange.
Yes.
A 1031 exchange no longer works for personal assets. So as far as a vehicle or anything like that, you cannot do a trade-in and do an exchange on that. It is only for real property. And again, if you have that situation, you definitely want to reach out, whether that is a 1031 exchange where you are selling a property and you're wanting to exchange into a new property and avoid or defer the tax. It's not avoid, sorry, you're deferring the gain.
Yeah.
Or even if you're involved in what's called a 1033 exchange, meaning either you've had a disaster to your home where you're having to, move into a new facility, or if the government has come in and condemned your property, definitely reach out to your tax advisor on that. There are unique situations. There are time frames and time limits that you have to comply with. So there's some strict regulations with regards to doing those type of exchanges.
Good. All righty, folks. Well, I think we are at the top of the hour. It's been a blast for 2024 doing First Friday 401ks. And again, this idea was Rose's. She just on the spur of the moment came up and said, why don't we do this? And I quickly thought it from a compliance point of view, which is naturally where my head goes, and got it through. And here we are. So I haven't chatted with Rose, but I think we'll be picking these up in February because January is going to be a little chaotic. And Tami, I haven't brought this up, but I am going to try to have you back. I know tax season is ridiculous, but I'm hoping and praying if I schedule it early enough, maybe
Sure.
the February, March one, you could just squeeze out a little time because I know people are going to be even more wanting to jump in with individual questions. And this is something I really avoid.
Yeah, definitely. If there's anything I can help, especially when we're thinking about it, that it
Yeah.
helps on my end if I can help people get a little organized on their end. So no
All
problem
righty.
whatsoever.
All right. Well, take care, folks. Have a wonderful holiday, and we'll catch up next year.
Thank you so
Thank you,
much for the,
Tami.
thank
Happy
you.
holidays to all.
Well,
Thank you.
bye
You
now,
too.
folks.